So if you are a trader who has never been funded, or you've been funded but you keep blowing that account, the number one reason I see for that, and even in my own journey, the major thing I lacked was not theory, was not understanding. What I truly lacked was a specific predefined plan. Now, that one sentence that you hear around in the industry, which I think is a complete cope mechanism, is every strategy works, which is complete nonsense. If every strategy worked, everyone would be profitable. But there is an element of truth in there, is that if a strategy never ever worked, no one would believe in it. But what you have to realize is, if you're going to run a marathon, would you rather walk a marathon uphill or on flat terrain? Meaning to say, some strategies will just be harder. You will have profitable people, but it'll only be 0.1% of the traders. And in other strategies, maybe 30% of the traders who trade that strategy are profitable. So why make it harder for yourself? Whether you're a pattern and trendline trader or a M1 timeframe liquidity trader like myself, what unifies everyone within that profitable category, regardless of strategy, will always be a clear, predefined plan. Especially if you're in a situation right now where you think you know a lot of information and you want to go ahead on this journey towards profitability. I want you to imagine 3 phases. You can go from A to B like a baby and crawl your way over there, and you'll eventually make it to your destination. And as a child develops, they go from crawling to starting to take steps, and they start to walk towards their target. And eventually, when they mature into their teens and become an adult, they can actually run directly towards their target. In all 3 scenarios, whether you crawl, walk, or run, you will end up at your target. But I would much rather run towards my target than be stuck and crawl towards my target. And what's funny for me to see 8 years later in my journey is that the people that are trading, let's say, a head and shoulder pattern, they are not wrong. They're just looking at the market from a perspective of crawling. But if you go a little bit more advanced and you go from crawling to starting to walk, you will start to realize that a head and shoulder pattern is a strong reflection and nicely mirrors Wyckoff theory with its accumulation and distribution. And you think, okay, head and shoulders started to work, but Wyckoff theory, this is powerful, this is detailed, and you'll think you really cracked the market. And then you go a little bit more advanced and then you start to run and you realize, okay, head and shoulder patterns was nice, Wyckoff theory was better, it was more powerful, but how much more can be revealed with M1 mastery, with understanding liquidity, inducements, daily cycle variance, all of these characteristics, how it all looks quite similar to Wyckoff theory, which looks very similar to a head and shoulder pattern, because in the end, they are all reflections of each other. And in this case, I believe the true concentrated information is really deep in the 1 minute time frame when you understand liquidity and inducements and all of the cycles that come along. This is the specific knowledge that I use to really find my level of profitability, and this approach has made me millions of dollars from the market. So the absolute beginner trader, baby pips 101, will be the pattern trader, and they'll be utilizing a lot of patterns that I'm sure you are already aware of. For example, a wedge, a flag, a double top, or even a head and shoulder pattern. These are going to be relying on looking at the market from its shapes. And again, even though I'm not a subscriber of it, I do believe it has a level of validity, because in the end, these patterns do repeat. I'd say learn this and learn how to quickly move on, to only use this for pattern recognition and a good foundation point, but you develop it much further in pursuit of real profitability. So what we have over here is a typical head and shoulder pattern that you could apply on, let's say, a 1 hour time frame where you're looking for this shape where you see a left shoulder, a head, and a right shoulder. Once you've identified this pattern, you are looking to execute a sell on the right shoulder, maybe utilizing a Fibonacci level and utilizing a higher time frame supply zone. And that would be a very rudimentary introductory way to trade the markets. So first way to deconstruct a head and shoulder pattern is layering it with market structure. So you will see that you have a bullish market where you're forming higher highs and higher lows as such. And when you have seen the bullish market structure, eventually you'll have the last higher high, the high in the market that leads to a new lower low. And therefore a bearish market structure will ensue. So in blue, let's do the internal structure, which is within the bullish impulse, within the last higher low to higher high, within that main push, you have internal price action. And eventually you'll go on to see a break of structure or a level of support forming. Either one. And what that area is referred to, that level of support, which is around this area, in a pattern trader's perspective, that is referred to as the neckline, where you have the left shoulder, you have the head, and then you have the right shoulder, all coming towards the neckline, which is supporting the price action. And if you take it a layer further, usually you'll see a market structure shift, a bearish intent from this absolute high to form a new lower low. So when you see price comes into the supply area and then terminates as bullish price action and then has a bearish shift thereafter, that's when you have the duality of confirmation of higher time frame supply zone, H1 time frame bearish break of structure. You're seeing the conversion of price action to go from bullish to rounding off to coming bearish, and then you're seeing a level of support forming. And a level of support forming is a sign of exhaustion. is to say usually price comes to a level or it goes higher and then higher and then higher. But then when you get deeper retracements, price starts to consolidate. Price goes from a trend to consolidation. That is sign of exhaustion. That is sign that the buyers are losing power and the sellers are starting to gain. This tug of war represents how buyers and sellers are in a battle, and in the beginning of a trend, the buyers are really winning. The buyers are pulling, hence the bullish price action. And then it starts to come to a midline where they are in equilibrium because the sellers are gaining control. And this support level wonderfully represents that, where we are going from the buyers are in control, bullish trend, to now getting horizontal consolidation, hence equilibrium, and then eventually bearish price action, showing that the sellers won that battle and then gained control. And therefore the signs of that will be after the lower low is formed, you have a lower high, and then you continue to form lower highs and lower lows. And therefore what you see is a full market cycle from bullish expansion to consolidation to bearish expansion. And these are the building blocks and foundations for actually wick-off theory, which will be the next stage on learning how to walk. So what will the head and shoulder trader do? They may start to look for trend lines. They may look for support and resistance levels within. They may look for candlestick patterns, for example, a doji or an evening star or a hammer. So there is a multitude of approaches, and it can go really deep. For example, people utilize Elliott wave theory, they can utilize harmonics, but that's not the key point. I want to show you how this basic approach can reflect something a lot more powerful, regardless of how you refine the entry. Because remember, there's the generation of the trade idea, which is a reversal based on a head and shoulder pattern. And then there's the execution. Now that execution can be on various approaches, trend line, Fibonacci, reversal patterns, but let's focus on the trade idea. And the execution is a variable depending on the individual. For the sake of this example, let's use a Fibonacci level where we can see price does a bearish impulse, and then we have the fib retracement, usually into the golden pocket, which is between the 50 and 71.8, usually hyper-focused around the 61.8, the golden ratio. So this is how those traders will execute the trade. They'll see the head and shoulder formation. Once they've identified that, they may supplement it with higher time frame trend, market structure, fundamental analysis, and then the execution can be a whole world. Let's say in this case, they are utilizing a doji candle upon a 61.8 level. Hence, they execute the idea over here, and they are going to target price to come at least to the neckline, but actually go on to form a lower low. And depending on the trader, they will have their stop loss based on the candlestick pattern, therefore a relatively small stop loss. Some people will place their stop loss above the 71.8 fib level. Other traders will just have it at the complete retracement. Regardless of the way they trade, this is the basic premise. Therefore, we have concluded a complete head and shoulder pattern where we have left shoulder, head, and right shoulder. Usually the left and right shoulder are at a similar level, and the neckline being a support level that breaks to confirm the pattern. So this is where a lot of traders are at, and this is where a lot of beginner traders, especially within their first 3 months, are at, but they're still crawling. And there are a few traders that have found profitability. In fact, on my podcast Titans of Tomorrow, there are a few traders that have shown profitability that still trade patterns. So it's not to disregard it, it's just to say this strategy can work. You just need to be very competent in other things, for example, market structure, fundamental analysis, and other supporting confluences. And second of all, it is very uncommon to find profitability with this approach. So therefore, my advice to you would be, I didn't find profitability like this. I know most people don't find profitability like this. So therefore, remember, exceptions do not define the rule. And despite there being a few figures in the industry that find profitability with this approach, the exception does not define the rule. And this way alone is going to be harder for you to find profitability than the next stage, which is learning how to walk now. And that's going to be utilizing the same markers of price, but utilizing now wick-off theory. So next, on the same price action type, you will see the head and shoulder trader that is basically looking for a reversal can be explained and justified through another strategy, which is a little bit more advanced, and that will be wick-off theory. Now, wick-off theory is an approach I was utilizing in the market for a few years. It's something I studied in depth, and in fact, even on this channel, I've done a few wick-off theory guides. And wick-off theory is a very well-documented strategy. It's something that's been around for as long as I've been alive. It's something that many phenomenal traders have utilized, and it was an approach I used to actually find my profitability. And the basic principles that I want to say in this video is that you have market phases, and these market phases are very few. You can have the market going up, and that's a bullish expansion. It can be going horizontal, and that will be a distribution. Then it can go down, that is a bearish expansion. Then it can go through consolidation, and that will be an accumulation before a new market expansion. Within there, you'll have a few other components. For example, after a distribution, to continue a trend, you have a redistribution, or after an accumulation, you have a reaccumulation to continue the bullish expansion. So the market phase will be very simple. Bullish expansion, distribution, bearish expansion, accumulation, bullish expansion. And that's how the market usually moves. Layer this with fundamental analysis, layer this with higher time frame, frame and advanced market structure, lower time frame confirmations, and start to bring in smart money concepts, inducements, daily cycles, lower time frame confirmations, time of day, small introductory components of daily cycle. This led me to have my first taste of profitability. Furthermore, it was really optimal for swing trading because if you could identify a higher time frame, valid supply zone, a valid distribution, you were entering before a new bearish expansion within the market cycle. You were able to get large swing moves that were aggressive, that were new trends, and therefore it was like position trading. You were not catching a small move within a trend. You were catching the majority of a trend, backed by fundamentals, backed by higher time frame, backed by lower time frame confirmation types, and the trade idea generation being Wyckoff theory. Very powerful, leading to very high risk reward trades and quite a reliable approach, and significantly upgraded from the pattern traders, let's say the rudimentary approach of head and shoulder trading. Although be it very similar in appearance, the justifications are a lot more advanced and therefore a lot more confirmations of each component and therefore more reliability, accuracy and precision because you're utilizing more advanced theory. So to summarize all of the complexities and the full theory into a few moments, what I really want you to focus on is this zone of consolidation. And usually after a trend, the market needs to cool off. That tug of war analogy I was mentioning. So that zone of consolidation is the beginning point of a distribution or an accumulation. Consolidation, which is the cause leading to a new effect, the law of cause and effect, meaning a new market expansion. Pair it with a higher time frame supply zone, just like the pattern traders, and you are looking to establish the range between the buying climax over here and the automatic rally. That will be the distribution range, the zone of consolidation. And what you'll see, you'll have market testing the low, like the neckline on a head and shoulder trader, and these will be signs of weakness. And that bottom range will be the support, and then the resistance will be established by the buying climax. You'll have a secondary test in phase B. The first phase is A, second phase B, D, E, and then you have the expansion. So the markers of phase A is the buying climax and automatic rally. You have the secondary test in phase B, and then you have an up thrust, breaking the range a little bit, maybe not coming to the refined area of the supply zone, and maybe not grabbing enough liquidity to fuel the move lower. Other types of schematics, for example, schematic 2, the high will be the up thrust, not the up thrust after distribution, which is in the next phase, phase C. And this is a schematic 1 type, the most common, the most reliable, the most powerful, because it's the final run of liquidity, and you will have a test within the same phase, usually a inducement and mitigation from what we understand, or from a smart money perspective, it can be order block and mitigation, optimal trade entry and so forth. And then you'll see sign of weakness in the next phase. That sign of weakness will be essentially testing the support level, testing the neckline, and maybe even a break of structure indicating the law of cause and effect is starting to take place, where you have the higher high into supply zone, maybe running liquidity, leading to the effect, which will be sign of weakness, maybe a break of structure. And then you have the final retracement, the lower high to form the lower low, the right shoulder from a head and shoulder perspective. And in this case, it's the last phase, phase E, before a new low is made, the expansion begins. That's the last point of supply, and that will essentially be mitigating a supply zone within the distribution phase, usually within the previous phases, the test or the UTAD. But you can see how it looks visually very similar to a pattern of a head and shoulder, where you have the left shoulder, head and right shoulder, but there is a lot more confirmations, confluences, rules, and exact requirements to establish a valid range as opposed to just a generic pattern, because we know patterns are broad. It's just simply looking at optics, and therefore that can fail time and time again. So to increase the probability, they add in a lot more confirmations to know it's not just something that looks like a distribution, rather these confirmations will confirm it's actually a distribution, meaning sellers are entering the market, buyers are exiting the market, and a new bearish trend and expansion is about to ensue. So therefore it requires specific confirmations within all of the phases of the distribution, with all of the points of the distribution, where you have the buying climax, up thrust after distribution, test and last point of supply, confirmed by the signs of weakness. Now you've taken it a lot further than just a head and shoulder pattern, and the way you execute on this trade idea will also be a lot more advanced. And there are two major ways to trade it. First one will be upon the test, and maybe you just put the stop loss at the high, utilizing a lower time frame confirmation, looking for a new lower low. So you can actually get from 5-minute time frame, 1-minute time frame trading, a confirmation type that will give you a 5-pip stop loss. And again, I've done many videos on this channel. I've even given public signals of exactly this type of trading, where you are catching a swing trade, you are catching a full bearish expansion that can be 100 pips plus, but you're utilizing a 5-pip stop loss. So then the risk to reward can be very high, 1 to 10, 1 to 20, 1 to 30, 1 to 40, well documented from my public signals back in the day, YouTube videos that I've done on this channel, case by case specifics, and even many case studies on Instagram. However, there was still a lot of problems that I didn't love about it. Namely to say risk to reward does not mean ROI, return on investment. So even though there was a 1 to 30 risk to reward, in theory, your actual gain may have only been 7 to 10%. And the rate of return while you're swing trading, so to get that percentage gain, it would take weeks on end. And additionally, these opportunities do not come about that often. So my trade frequency was low, my rate of return was low. And even though I had a high risk to reward, I didn't have a high ROI. And that's what you really care about. Hence why I took it a stage further to the way that I'm trading, where I have a high trade frequency, high risk to reward, high rate of return, high return on investment ROI, and a still respectable win rate. And therefore optimizing for equity curve growth in a optimal way that is not going to be sporadic high wins, rather a consistent linear growth curve that is not shallow, but rather inclined to be a fast rate of return. And if you just look at my track record of the last 7 months of the public signals that I've been calling live ahead of time, entry, stop loss, take profit, and full explanation of my live call outs, 63 trades, over 55% gain in profit is a reflection of a extremely high level of profitability with every KPI that you would need optimized. So in this phase, you are more advanced than a smart money trader because you are entering before the right shoulder is formed upon the test, or even on the last point of supply where the head and shoulder traders are also entering, but you're utilizing a lot more confirmations of the trade idea and better confirmations within the entry type upon those confirmations. So better trade generation and better execution criteria, leading to a better win rate, more reliability, more precision, and overall better profitability because you have more confirmations. As you know, I'm a firm believer of a restricted trader is a profitable trader, and therefore to be a restricted trader, you need a better, more qualified, predefined plan with more restrictions, more confirmations, more qualifications, more theory, more understanding, more everything. And therefore, this is significantly better than pattern traders. And that's where your next stage in evolution should be. But this is not the end point because, as I've just mentioned, there are still negatives within this. And this was me adding my twist as it was. From Wyckoff theory alone, it's very similar to the head and shoulder trader where you have your entry upon the test or last point of supply. Some Wyckoff traders even put it on the sign of weakness on phase E and their stop loss at the high. So then you have a stop loss range the size of the distribution range, which is going to be a large stop loss and is going to lead to a swing trade, yes, but a very low risk reward. I mean, even if you enter upon the test or last point of supply, you'll still have a 30, 40, 50 pip stop loss, which is fine for swing traders. But I added my own approach, which allowed it to have a small stop loss, hence the high risk reward. So I added my twists onto it already, utilizing smart money concepts, market structure, and so forth. But the level further was introducing the liquidity cycle, inducements, advanced market structure, and the structure cycle, daily cycle, M1 mastery, and confirmations to take this to a whole nother level and optimizing for intraday and intra-session trading. To be able to trade within the range, pre-expansion, within these moments of highs and lows, intraday trading, and then actually catching the expansion if you want to as well, to actually capitalize on swing trading and intraday trading and intra-session trading. So you're trading the consolidation and the expansion. Now, the last stage is learning how to run. And when you learn how to run, this can go very in depth. And in fact, the way I trade is quite advanced and not really fully easily captured by a complete beginner. I can't teach you a full strategy and everything I do in a small YouTube video, but I can give you a beginner strategy that will be perfect for profitability and within the percentiles of success of profitability with every strategy. Let's say a head and shoulder pattern trader type, only 1% of those traders are profitable. Within the Wyckoff theory trader community, I would say 30% of these traders that understand it correctly can actually be profitable. But I would say the last method that I'm about to give you, over 50% of these kind of traders will be profitable. I've seen it in my experience. I have helped hundreds of people get funded with these approaches. So in my experience, I know that the percentile of success is rather high. And therefore, for any beginner trader, I would definitely advise looking at the market from this lens. And this lens is going to be liquidity cycle, structure cycle, and daily cycle. Within there, I need you to understand advanced market structure, inducements, specifically major and medium inducements, and then lower time frame confirmations. So then if you can take a similar trade type, but upon your entry criteria, you are utilizing daily cycle, so the key time windows, session volatility for the most volatile moments, paired with inducements, so you have volatility plus liquidity, and lower time frame confirmation types with market structure, man, you're going to be in a very good spot because you'll be able to have high trade frequency, high risk reward, high win rate, and overall a optimized strategy with extreme confirmation types, with a lot of mechanical components that are going to be KPI driven driven, but also data driven, so that every execution you're trading is within my mantra of a restricted trader is a profitable trader. I'm not going to give you flimsy approaches. It's going to be confirmations and confluences that are backed by theory and backed by data. And within my years of implementation and application and my market experience and market IQ, I can completely vouch for this approach, which is going to be completely optimal, including for beginners, because I'm going to give you a very specific trade model utilizing the confirmations that I like to use. And that trade model is going to be a support to resistance inducement model, S2R inducement model. In fact, I did a whole video breakdown where I explained the entire model step by step, the exact confirmation checklist, and gave you a step-by-step trade example going through the intricacies of each confirmation type. And then a step further, I went through 2 weeks of price action to show example after example after example. So this case study video, I need you to watch it in its entirety to fully understand the trade model, the exact rule sets, and exactly how to enter upon it. But in today's video, I'm going to show you the overarching summary with a few key nuggets that I left out in that video, so you can know how to generate the trade idea from that previous video. And then in this video, you can completely understand the execution criteria. So very similar to the head and shoulder pattern traders, where you have left shoulder, head, and right shoulder with the neckline over here. It ticks the boxes of the optics of a head and shoulder trader. From a wick-off theory trader, it can also be very similar, where you have the buying climax, you have the up thrust, you have the up thrust after distribution, you have the test, you have the last point of supply with your sign of weakness over here, and then a bearish expansion. So from wick-off theory, it can be very similar, but we are going to take it a step further. And if you remember from my previous video, the key markers were, if you can identify an inducement, major or medium. Now, the high, the UTAD from wick-off theory, it needs to be within a supply zone or a major inducement, meaning liquidating a significant market structure point. Additionally, if you can have Asia range inducement or medium inducement or a smart money trap inducement, these will certainly help because it identifies the inducement of the day. Once you have identified that, ideally in a key time window, this will be usually on a London open, the first hour of London. If you can find a major or medium inducement, specifically followed by a smart money trap, then you have found a confirmed high of this support to resistance inducement model. Then you need to see a bearish reaction with smart money traps within, but you are looking to identify a support level pre-break of structure with multiple touches, 1, 2, 3, and so forth. You might see further follow-through inducements that will certainly confirm that this is the inducement of the day. Now, once you see the support level formed, you might see an inducement that leads to a break of structure. Once you see that inducement lead to a break of structure, now you have seen the first confirmation types of this model, where you have major inducement followed by support level, followed by a medium inducement internally, followed by a break of structure. Once you have seen that, then you need to see the test, because retail traders, what do they trade? For example, breakout traders, they see resistance, break, test, continuation. So this will be resistance level, break, test, continuation. Where are their liquidity? Their liquidity is going to be right above. Plus buy orders are going to be pending here. Plus breakout traders that are seeing this resistance are going to see break, test, continuation higher. So you're going to have a whole liquidity event happening here where you're going to capture sellers from the resistance traders and even smart money traders. You're also going to have the liquidity of the breakout traders and bullish market structure traders and all other kinds of bullish traders that are going to be captured here. So you capture sellers' liquidity, you capture buyers' liquidity, and this liquidation event will be upon the support to resistance. Once that resistance is confirmed, you have an inducement into a nearby supply that is going to be a major inducement event that we are looking for. Once you've identified that major inducement event, you will see a bearish expansion. Very similar to the last point of supply of a wick-off theory trader and can be quite synonymous with a right shoulder. But we are not going to utilize a trend line and a Fibonacci level like a head and shoulder pattern trader. We are not going to utilize the wick-off theory confirmation types. Rather, we are going to use a specific confirmation type, which is going to be upon the nearby supply zone, after the build-up, that is the resistance level, getting induced and mitigating that supply zone. Within this inducement event, before the expansion, you need to look for two specific things in this area. Again, if this is not fully making sense, you need to watch the previous video to understand the full step-by-step criteria with the multiple examples I showed. But what I need you to focus on when you are at this point, you need to do two things. Number one, once you've understood what an inducement is and mitigation of a supply zone, correct identification of a supply zone, all of these things are on my channel. Confirmation of supply zone, refining a supply supply zone, beginning steps of an inducement, then you need to know time relevance. So if you can get a New York continuation trade model, the supply to resistance model is going to be usually a New York continuation trade. So therefore, if you can be in the second hour of the New York window, not the first hour of New York, because that's usually a inducement and trap, a 1 hour to 1 hour 30-minute buffer, a mechanical objective window as a confirmation type. If you are in your key time window, which is a marker of the daily cycle, pairing it with the inducement of the support to resistance model, tapping into a confirmed supply zone, you are in a very strong position. And now to capitalize on high risk reward and session volatility, you have the time window plus an inducement for volatility, and confirmation will be lower time frame confirmation models. Now, lower time frame confirmation models, there are many, and within my arsenal of deployments, I will have over 10 types of lower time frame confirmation. So I won't give you all of them today, but I will give you my favorite one, which is going to be a simple M1 internal breakup structure, which is simply put, if you have done everything for the support to resistance model and you have identified the valid supply zone that I mentioned. So very quickly, for example, you have the build up, and then inducement, the major inducement we are looking for. And then we have eventually a bearish market structure shift. We have a lower low formed. Upon there, we identify a support level, pre-breakup structure, and then a supply zone that led to a breakup structure. Once we have identified those components, we need to see the breakout traders being fulfilled. So we have a support level, a break, and then a test. We need a support level turning to a resistance level. So what a breakout trader is going to do upon this support turning into resistance, they wait for the break, like so, they wait for the test, like so, and then they wait for a continuation. Break, test, continuation. Then we have all of the liquidity that is formed on this resistance level. So what we will need to do, again, watch the guide to fully understand it. But when we have the inducement of the break, test, continuation zone, and we come into the nearby supply zone, ideally a medium inducement that led to a break of structure, we are waiting for our key window of time, the New York window of time, and then we wait for the lower time frame confirmation type. So specifically speaking, over here, we want to be seeing internal price action on M1 that is bullish. And then when we see that M1 bullish price action, have the last higher high going on to make an internal break of structure and form a lower low, then we need to wait for the retracement mitigation and new lower low. So you're waiting for a real break of structure, not an internal break of structure, from the last higher low to higher high to form a lower low. Then you're waiting for the retracement to mitigate a refined IFC, specifically pairing with the imbalance that's needed. And then once you've confirmed that on M1, you put your stop loss in your key time window, remember, with your stop loss at the high. And then you are trading the session volatility after an inducement. So inducement, which is liquidity plus volatility of time session with lower time frame confirmation, is a trinity that is unmatched. It's super powerful. And when you have that execution criteria upon a trade idea, which is the support to resistance inducement model, you will now be able to enter a optimal area based on time, based on lower time frame confirmation, based on higher time frame zone. And you don't need to put your stop loss at the high of the zone. You put your stop loss based on the 1 minute time frame confirmation. So you don't need a 10, 15, 20 pip stop loss. You can have a 3 to 5 pip stop loss very consistently. But then after that inducement, you are waiting for a new lower low to be formed. Take your partials at 1 to 3 and 1 to 10 risk reward fixed. 1 to 3 risk reward, take 50% volume. 1 to 10 risk reward, take the full volume. And now you have a optimal trade that is very beginner friendly. You just need to learn these components, which will not take you a long time. This happens fairly often. It's very mechanical, very rule based. So this is the journey you will have. As a trader, you will naturally look for more and more refinements, more improvements, and you'll be in pursuit of something. And at the beginning of your journey, you don't know what you're in pursuit of. So you go all over the place from mentor to mentor, from strategy to strategy. So let me save you the hassle, because I've been doing this exact process just like you have, just like hundreds before you have that I've personally helped, and it's led to profitability. And the journey is not strategy hopping. It's looking for refinements that are specific like such. Learning how to crawl, which will be head and shoulder trading with executions on, let's say, trendline and Fibonacci and doji candles. Then you learn how to walk. And when you learn how to walk, you introduce wick-off theory with advanced market structure, with SMC, and you are optimizing for swing trading, which can be profitable. And a lot of people will find profitability there. But if you want your best bet to find profitability rather quickly as a beginner, I would introduce the support to resistance model, optimizing for the structure cycle, daily cycle, and liquidity cycle, pairing it with an inducement that I've shown you in the model, time window based on the daily cycle, and a lower time frame confirmation that I've given you. This will be your best bet. So this is the best advice I can give for any trader, wherever you are in your journey, to focus on this trade model, because it will, I promise you, it will make you a lot of money if you know how to do it correctly and you stay patient on the process, because I've done it and I made a lot of money. I've also helped hundreds of people make a lot of money, and now I'm bringing it to you guys with complete proof, complete transparency from my public signals to a step-by-step approach. You just need to do the hard work to test it out and apply it yourself, and I know you'll make it. I know you'll be profitable as long as you remember the key thing, which is a restricted trader is a profitable trader.